And welcome back, folks. The Ray program, 844-RAY show. Gene Pastula, CFP in the house. I was teasing before you came on there, Gino. Did you hear it? Okay,
yeah,
good.
Yeah.
You also must have heard then me talking about the article in Investment News, why security in retirement is often luck of the draw. And you and I have discussed this before. We don't know on the date that we retire what the market's going to do and how that's going to impact or affect our portfolio in retirement. And Wade Pfau wrote about this, and it's actually quite frightening when you read through it, because depending on whether you were the lucky one or the unlucky one dictates whether you have a comfortable retirement or maybe no retirement at all.
You know, timing is everything.
It really is.
It really is.
But here's, and this is what I was alluding to. He said this, quote, "I calculate the wealth accumulations for benchmark retirees turning 65 each month going back to January 1950. I mean, the guy's a propeller head. This is the kind of stuff that he does. Really complex formulae and et cetera, et cetera. Wealth accumulations are expressed as a multiple of the final pre-retirement salary. These values range from a high of 18.4 times salary for a retiree on September 1, 2000, to a low of 5.9 times final salary for a retiree on August 1st, 1982. In January 2015, the benchmark retiree would have accumulated 10.7 times salary. So, I mean, absolutely not bad, but that guy in 1982's got big trouble.
You know, every mountain chart you look at that shows you how a portfolio is performed going back 10 years or 20 years or whatever, it all depends, the end result all depends on when you start it and when you finish it. So in a situation, I mean, it's just, that's an obvious thing. I hope he didn't spend a whole lot of time.
Well, I'm sure he did, because this guy, he analyzes the analyzing.
Yeah, right.
But he also says this, despite saving quite responsibly over a 30-year period, today's benchmark retiree could only safely replace 38.9% of their pre-retirement salary using the accumulated assets in their portfolio. Obviously, you would add Social Security to that. But you know, that's a bit frightening to me, because most of us will, at least in the first decade or so of retirement, spend fairly close to what we were spending prior to retirement. Then it starts to taper off. But the first 5, 10 years, people want to travel, they want to do things, get it out of their system. Guys like you are going to go, you know, to Europe. When are you going to Italy again?
I'm going to sit at home. I've done enough traveling. Actually, I am going to Italy
in
a couple of weeks. Yeah.
And you didn't invite me to go.
we couldn't.
Well, I think you invited me to go, but you said I had to pay.
Yeah, something like that, you know. And find us a big enough car.
844-RAY show. If you have a question for Gene, certified financial planner Gene Pastula, he runs the Safe Money Monitor website, so he knows all about safe money strategies. There was an article that Liz Weston wrote that I saw this morning. I wanted to share with you, Gene, and all of our viewers and listeners. You may be saving for emergencies all wrong. Here's what Liz had to say. Every time you manage to put some money aside, an unexpected expense comes along that wipes out what you've saved. Unforeseen costs are actually the norm. 6 out of 10 Americans said they faced an unexpected major expense last year, according to a Harris poll. Here's the thing, she goes on. Many of the bills people cite as unexpected are absolutely predictable. I've heard that from Gene Pastula. If you have a car, for example, sooner or later, you have car repairs. If you have a house, the same is true. If it's not the roof or the furnace going bad, it's the plumbing or the wiring. If you have a body, you have medical bills. If you have teeth, you have dental bills. Knowing these expenses are coming is one thing. Knowing exactly when they'll hit precisely and how much they'll cost is another. But with a little effort, you can come up with some decent approximations. You're in the business, Gene Pastula, of helping people save for their retirement and manage emergent expenses. What's your reaction to that?
Well, clearly the definition of an emergency account is to be able to pay for emergencies. So with that said, however, she's definitely right. You know, things that some people, you know, kind of wake up and say, oh, you know, my car needs servicing and it's going to cost me $1,000. Well, that should have been anticipated, and it should be, you know, part of the budgeting. What I see a lot of, particularly in younger people who have, I've experienced several younger people in my life that I've been involved with as a result of their parents requesting me to assist them with, you know, inheritances and stuff like this. And it's amazing how, you know, they can come up, they can have this money there, and it almost like burns a hole in their pocket, and they really have to go after it. You know, if they have to find a reason to spend it, you know, in emergency. And so a lot of that, you know, the problems with those with emergency accounts, what have you, is that the people don't have the discipline to, if it's too easy to tap, if it's too easy to get at, then they'll find they'll take the easy way.
They'll find the emergency.
That's right, and they'll take the easy way of, okay, I need to take money from here, instead of just leaving it alone, because here left there will accumulate into something very important by the time they're getting ready to retire, that they'll be glad they have. And whatever that emergency was at the time will have long passed and been taken care of in some fashion. So it really boils down to some discipline.
I mean, it's budgeting.
Yeah,
you really need to, I mean, when you're doing your budget, you have to look at those one-time expenses or some anticipated expenses and build in X amount of dollars a month that you put into a fund. And it's really not an emergency. Those are like real expenses, like I'm getting my car smogged and oil changed today, right? Now it's going to cost me, because I put you heard me during the break.
Yeah, you
put the good stuff in, I put the
in
expensive oil in, and I get the smog check, and it's going to cost me $120.
Yeah.
Well, that's this month. $120 not budgeted for, right?
I assume that's the case. But in your case, it's just a matter of flipping them the plastic and we move on.
I'll flip them something.
Well, you know, my thing is that you're right. When in the context of investing and you know, your financial planning in the future and what have you, there should be assets set up in your account, or you should purchase assets that are really a little bit more difficult to get to than just writing a check or drawing it out of the bank.
Absolutely right. And Gene Pastula, by the way, if you want his pearls of wisdom, which he sends out all the time, and they're really, really good, except for I caught a couple typos in the last one.
I know.
Gene Pastula, go to safemoneymonitor.com. Check him out. Well, don't check him out.
Check me out.
Check out what he writes about, because it's really brilliant stuff. SafeMoneyMonitor.com. Now, when we come back, Michael Kitces writes about something, and you're not going to like it. Well, you might like some of it, and I have got the answer. Do you believe that?
I showed up this morning.
It's a good thing you showed up so that I could give you the answer to the question I'm going to give you. It's on the hybrid life insurance long-term care policies, and a weakness he says that is in them. Don't go away. Gene Pastula, my guest. He is one of the founding fathers of what is called a hybrid life/long-term care contract. And one of the propeller heads that I quote all the time on this program, Michael Kitces, wrote about it not too long ago. Are hybrid life LTC and annuity LTC cost guarantees worthwhile? Welcome back, folks. Gino, I want to read this because I think it's important. In some respects, he's sort of challenging something that you've talked about in the past. And I want to run it by you because I have my thoughts. He says this: as traditional long-term care insurance becomes more and more expensive, and interest rates remain at ultra-low levels, planners and their clients have become increasingly interested in the so-called hybrid LTC policies that match together a life insurance or annuity policy with long-term care coverage, especially with a more favorable set of tax rules that took effect in 2010. For many, though, the primary appeal of hybrid policies is the simple fact that unlike their traditional LTC insurance brethren, the premiums really are guaranteed and cannot be increased in the future. Given some of the extraordinarily large premium increases that traditional LTC coverage has experienced in recent years, especially for some of the early policies issued in the 90s, a cost guarantee is remarkably reassuring. So there you have it. On one hand, he is saying, doggone it, you should go out and own this because this is a really good deal, right?
Sort of, yeah.
But, then there's always a but, he comes back and says this, yet the reality is that the guarantee of long-term care premiums in a hybrid policy may be, emphasize the term may be entirely offset by the fact that the insurance company controls the cash value and is under no obligation to pay a going rate of return, especially if interest rates rise. So here he is presenting both sides of the argument. You should do this because it's a really good deal when interest rates are low, but those insurance companies, they could stick it to you in the future. Now, to me, I'm thinking, well, we're kind of sticking it to them right now because I don't know how they can provide the product that you talk about in this low interest. Well, I do know how, but most people wouldn't even dream of how they could provide this linked benefits plan. But I've got a really good answer to that. What's yours?
Well, actually, the cash value and the interest rate, once the policy is put in force, doesn't matter at all because in the context that he actually started out by saying is that the results of the money going into these and you're purchasing this account are all guaranteed, not to change. So whether the interest rate and the cash value goes up, down, or sideways will not affect the individual. If it goes up significantly, if it were to go up significantly, there might be, I don't know, a few extra dollars in the cash value of the product, but so what? It's, you're not going to use it, you're not going to take it. So, I mean, it's a nitpicky point
from a propeller head.
Exactly.
But let me just say this. And I totally agree with that. Number one is, and what's the guaranteed rate today?
Well,
ballpark.
Yeah, probably 3.
Okay, so 3%. Anybody getting 3% out there on a money market fund? On a liquid account? How about a 1 year or 2 year or 3 year or 5 year CD? No, I'm not getting that, are you? So interest rates got a ways to go before this becomes even an okay deal versus a smoking deal. But here's the other thing that I came up with, according to what Gene Pastula, by the way, I quoted you in my new book.
Oh, good.
You're quoted in there.
Good.
Some of that stuff you sent me.
It's
an ebook and I'm not selling it, at least not yet. Not until I correct all the
hopefully
spelling.
it's widely read.
Yes, it will be widely read.
Okay.
Because you're going to buy a whole bunch of them.
Okay.
You're going to buy 6,000
I'm going to pass
of
them
them.
out by the
Yeah,
tons.
you are going to do
All
that.
right. Okay.
And in either event, I do quote you. But here's the thing. According to Gene Pastula and according to the contract itself, this money is liquid. So Michael Kitces, you are a really, really smart guy. But if interest rates went to 12% and the insurance company said, well, we're not going to pay 12%, we're going to stick with our 3% guarantee, I think somebody smart like me or you is going to say, well, they told me I had 100% principal protected guarantee, so I'm going to call the insurance company and say, guess what, insurance company? You're not paying me any money. You're not going to pay me more than 3% when I can get 12 in a money market fund. Give me my money. I'm going to go buy a money market at 12. Isn't that the answer?
Yeah, that's essentially it.
So this product is really, really a phenomenal deal if people will just spend 5 minutes getting to understand it.
Well, and I was thinking as I was driving up here this morning that we haven't really spent much time on the annuity version of these products, which is a little less complicated because it doesn't have the insurance element in it. But if you can imagine you have a CD in the bank and they offered you an option of the existing CD where each month or each year the value in the account went up, was it 1% now? 1%. And you got a statement that shows next year 100 is 200, 101, and then it's 102 and $10 or whatever. Instead of that, it just basically sat there and just modestly went up just a little bit, but there was no tax on that. And if you needed long-term care, the 100 would turn into $200,000 or $300,000, a $200,000 or $300,000 pot that you could draw down on to pay for long-term care.
Okay,
there's
let me
no
hang on a
life
second, 'cause
insurance
I want to make sure
involved.
people understand what you're saying. The 100 was 100,000.
Correct.
Okay, you said 100, so I want to make
I'm
sure
sorry.
people don't think that
I
$100 would
think
turn
in thousands,
into $300,000. Okay,
I'm like you,
that
I'd buy expensive oil.
miracle worker Gene Pastula. So what you're saying is $100,000
Correct.
would turn into $300,000 of monthly payments. Obviously, you would
Or
use up.
total payments. Monthly, it would be more like, I don't know, $5,000.
Okay, sorry, I just did the
Yeah,
same thing,
okay.
didn't I? Golly. In either event, you would use up your money first,
Yes.
and then the insurance money would be used up second. But that's still a heck of a deal.
For all the people who have in the back of their minds, and if you don't by this time, you're not paying attention, that there is this risk out there that someday they may have to pay somebody to help them. But it's, they don't want to buy one of these insurance policies and all the rest of the stuff. So they're self-insuring, and they say, okay, well, I got plenty of money. Their financial planner says, hey, no problem. You got plenty of money, and you're fine. You can write checks for $7,000 a month, and for a long time. For those people to put some of their savings into one of these contracts, either the linked benefit, as we talked about with life insurance and have for months now, or the annuity version, where it's simply just a different CD, quite frankly. I mean, you're moving the money from one place to the other. $100,000 that was sitting in the bank is now worth $100,000 with the insurance company, and I submit every bit is safe. But it's going to grow very, very modestly, like the CDs do in the bank now, but without any tax. But then for long-term care, that $100,000 could turn into a $50,000 per year distribution, tax-free, for up to 6 years.
Okay, so how is that tax-free, though? An annuity taxation is different.
Because they passed a law.
They passed
a law that said if you're drawing the money for long-term care, see, the government knows that this is a big problem.
Yeah,
I mean,
that's
this is
amazing.
huge. This is huge. So if you, so the specific law that says, and don't ask me to quote the code, that says if you draw money from this annuity for long-term care, it will be not taxed. So now instantly I have, instead of that puny little $100,000 CD, when I'm looking at trying to pay bills for somebody to come in and take care of me, all of a sudden now I have literally a $600,000 asset in my example, or a $300,000 depending on the type of contract you're talking about. That I know that if this goes on and on and on, that the insurance company is going to start ponying up some of their own money after my CD has been spent, after my annuity has been spent.
Why wouldn't a person do that? I just don't understand why someone would. Okay, the life insurance one, maybe you got underwriting problems, you got a ticker problem, who knows what. But this would seem to me, underwriting's got to be pretty easy, right?
It's easier than life insurance,
Yeah.
yes. I mean, people want. I mean, they don't want to give this to somebody who's got on their way into a nursing home.
Right.
But if you're in average decent health, decent qualified by the fact that you're typically in your 60s or so, then yeah, it's not a problem.
Gene Pastula, phenomenal information right here. By the way, Michael Kitces, to his credit, does come back and explain where it does make sense for a lot of people. I was just picking on him a little bit. He's a really smart guy. Anyway, and so is Gene Pastula. Check him out, safemoneymonitor.com. Ask about the linked benefits plan or these annuities with the long-term care riders. safemoneymonitor.com.